Yeah, I think there's a few factors driving the rail stocks higher this year. First, as you point out, the economy has picked up. We had 4.5% volume growth for the rails in the second quarter, better than expected, best growth in about a year. Capacity across all of transports is very tight. Rail pricing is accelerating. We think it's going to continue to accelerate. Third, big management changes at CSX last year, leading to some pretty massive margin improvement this year. We're modeling around 600 basis points of margin improvement for CSX this year. Obviously, that's great for CSX. We think the implications for all the rails are really positive. We don't think we're close to peak margins yet. And then lastly, for the rails, they're generating record free cash flow this year, record free cash conversion, buying back record amount of stock and dividend. And we think that warrants higher valuations. So we continue to like the rails here.
Yeah, and certainly they've been some of the biggest beneficiaries of tax reform here in the U.S. as well. What do you see as the biggest potential risks?
Yeah, I mean, obviously, with the trade war, if we have an extended trade war, big impact on demand, that's obviously a risk for the rails. The trade war is bad. We're not seeing really any evidence of that yet. Rail volumes to start the third quarter, about a third of the way in, are tracking up over 5% quarter to date, better than what we expected. Anytime you're talking about Eastern rails, coal is always a risk. Met coal, though, at 180 a ton. Nat gas prices high twos. Hot summer. Doesn't feel like we have much near-term risk for coal. Something we got to keep in mind longer term. But right now, the risks feel moderate.
Yeah, and one of the things we've been reporting on so much here has been the truck driver shortage and the fact that you're starting to see congestion in terms of goods being able to be moved by truck right now. Are the railroads benefiting?
Yeah, first thing I would say on the truck side, we think the truck driver shortage is more of a cyclical than a structural or permanent thing. That being said, it's clearly very tight this year. Truckload pricing in the second quarter was up 15% year over year. That's the best we've ever seen in over 20 plus years in our models. That's a good thing for the rails. Rail pricing tends to lag truckload pricing by 2 to 3 quarters. It's why we have confidence rail pricing is going to continue to accelerate going forward. In fact, rail's the only place in freight where we think pricing is better in 19 than 18 from a year-over-year standpoint.